Hello, good morning, and welcome to today's Five with Fitz. I'm Keith Fitz-Gerald. Thanks as always for joining me and taking a few minutes out of your valuable day to be with me. Anyway, let's talk money and markets. Yesterday, I wrote to you that I expected another downside test before the session ended, and right on cue, that happened as the markets headed towards the closing. Now, today, traders came out of the gate and they lost no time sweeping out the orders. That's what it's called. You sweep out any orders remaining in the system from folks who yesterday bet on more downside because they got scared into doing something foolish. Now, having accomplished that and swept all of the scaredy cats off to the side, those big money traders are now flush with new cash, and yep, you guessed it, they're taking both the S&P 500 and the Nasdaq higher as I record this, while leaving the Dow in the red. Now, I think that the Dow could also go green by the time you see this, just because that's the way the ball bounces. So where do the markets go from here? Well, that depends on the headlines. Anything that reintroduces FUD, fear, uncertainty, and doubt has the potential to be a downer, while anything that inspires confidence can create FOMO, fear of missing out, if there's a sense that worries like tariffs, rates, and the economy can be relegated to the back seat, so to speak. Now, my POV, what I expect based on decades of experience, is that we're going to see range-bound conditions for a bit, with an upside bias lurking under the hood as Wall Street tries to protect that from the investing public. They don't want you to make money. They want to make money using your money. And it's a very different, subtle nuance. Now, what you want to watch to figure out which way the ball is going to bounce is the U.S. 10-year yield. Now, we've talked about this in the past, but a lot of you have just joined us, so this might be new information. But that's your tell. It's a poker term meaning your behavioral or physical clue that gives away your intentions, your hand effectively. Yields are down, as I record this, to 4.377%, which suggests that it's only a matter of time before the big money gets on the gas again. They can't afford not to. Investing in optimism is the purest path to profits over time. Never forget that. So here's my playbook today. Number one, Oracle could be a sleeper. Now, I never thought in a million years I'd say this, but it could be. Oracle beat both top and bottom line estimates for Q4. Revenue came in at $15.9 billion. That's an 11% increase year over year. Cloud services and support revenues jumped 14% year over year, reaching $11.7 billion. And cloud infrastructure revenue, IaaS, jumped 52% to $3.0 billion with a B, while cloud-based applications, SaaS, cloud-based applications revenue grew 12% to $3.7 billion. That is a lot of numbers, and I haven't had enough coffee yet. The company is expecting even better 2026, with CEO Safra Catz forecasting that total cloud revenue growth will accelerate from 24% in fiscal year 25 to over 40% in fiscal year 26. In cloud Oracle infrastructure, OCI, Oracle Cloud Infrastructure, actually, growth alone is projected to top, get this, 70%. 70%. Hoo-yah! I think there's a very good case that cloud revenue could accelerate even faster than Catz suggests, though. Think about it. There's more than $1.5 trillion flowing into AI in the advanced manufacturing needed to make it all work already, which means that Oracle could be a very interesting choice, a sleeper, to paraphrase my grandfather, who would often refer to under-recognized baseball players as having the potential to significantly outperform expectations. I mean, he was an old-time stovepipe league baseball guy, so he loved those expressions. Anyway, I miss him terribly, but that's what he would have called it, a sleeper. Leaps calls in particular could be interesting, so think about it. Number two, another Boeing down. There's no easy way to put this. I mean, I travel a lot, which is why it always hits me hard when I hear about something like the Air India Boeing 787 that was en route to London Gatwick, which crashed shortly after takeoff from Ahmedabad, if I pronounce that correctly, with 242 people aboard. Now, the cause remains unknown, and as tends to be the case in situations like this, could take months to determine. What catches my attention is that this is A, yet another Boeing down, and B, the first incident I'm aware of involving a 787 Dreamliner, supposedly Boeing's flagship state-of-the-art airplane. Now, this can't possibly get any worse, but it does. Boeing just reached a $1.1 billion deal to avoid prosecution over 737 MAX crashes in Ethiopia and Indonesia that were both attributed to faulty flight control systems. At the same time, there are reports that the latest investigation, started May 2024, includes Boeing disclosures that employees skipped inspections on some 787 Dreamliners and or skipped or failed to fulfill various safety requirements. I mean, this is a big deal. Boeing whistleblower Ed Pearson has called for a criminal investigation, not a civil investigation, a criminal investigation, because Boeing planes are, quote, not safe. If he's right, what's happening today is not even the half of it. Now, not surprisingly, Boeing stock fell over 7% in pre-market trading as the incident reignites safety concerns ahead of next week's Paris Air Show. Get that? I mean, that's totally unfortunate timing. But here's the thing, right? If there were no crash and the stock fell ahead of the Paris Air Show, I'd be tempted to buy it because that kind of activity would otherwise suggest big money traders sandbagging as of yet publicly unknown orders or something else material that could take higher prices ahead or take prices higher ahead. In this case, though, it's clearly not the case. Now, my POV is tough. I can imagine return to 52-week lows for Boeing of 128.88 without too much trouble if the investigations, plural, reveal even half of what the scuttlebutt suggests might be the case. Putskis, short, and avoid. Number 3, Bessant on tariffs, you get the carrot or the stick. Now, U.S. Treasury Secretary Scott Bessant just hinted that the White House might extend the 90-day tariff pause for 18 of America's important trading partners, provided they keep playing nice. So what, you say? Well, I get it. There's been a lot of posturing and bluster from everybody involved, so, But what catches my attention and what I encourage you to pay attention to, too, is that Bessant's remarks before Congress mark the first time a Trump official has cracked the door open for more time without a deal in hand. Now, that is a big pivot from previous terms or else tone. Now, don't confuse this with a broader thought, though. Commerce Secretary Howard Lutnick made it crystal clear China's still in the penalty box, deal or no deal. Number 4, Uncle Jensen and I agree. The rest of the decade belongs to autonomous vehicles, robotics, and intelligent machines. Now, I've made no bones about that, and you know that if you've been reading the 5 with Fitz for any length of time whatsoever. For years, I've spoken about this. But speaking at the Viva Tech conference in Paris, Uncle Jensen Huang described this as the decade of AV, robotics, and autonomous machines. I couldn't agree more. And not surprisingly, as I suggested for literally years, NVIDIA is positioning itself as the engine behind it all. And if that expression doesn't mean anything, let me put it another way so you understand the magnitude of what I'm talking about. You cannot afford to miss this. What he's doing is like selling shovels during the gold rush. The miners went into the mountains, very few of them became rich, but the merchants that sold the shovels made bank. NVIDIA is doing the same thing with AI, which is why I hope to heck you're on board. Now, I say that because, unbelievably, a lot of folks still aren't on board, and that's a shame. And, it's hard to contextualize this, but the numbers get really big in a hurry. You've missed out if you're not on board, and I don't want to see you make the same mistake going ahead because you could miss out again, and that would be terrible, given that you know what's going on. NVIDIA has returned 742%, and these are, approximately 742%, 1,429%, and 27,387% over the past 3 and 5 year, 10 periods respectively, versus 54%, 88%, and 186% from the S&P 500 respectively. Now, what makes this tough is that investors I hear from all the time, all around the world, swear up, down, and sideways that they won't miss the next whatever, only to do exactly that. Then you have another crowd. Many buy ETFs and funds with hundreds of stocks, including NVIDIA, because they think they're getting a back door. And then they wonder why they're getting left behind. And the answer is deceptively simple. If you're buying ETFs and funds, and there's nothing wrong with doing that, it works for a lot of people and it has for a long time. And if that's what you're comfortable with, do it. But what I want you to understand is that buying ETFs and funds is also like buying cable TV, in that you've got to buy 200 channels just to get the 1 or 2 you actually want. The diversification that you think has helped protect you, arguably and very likely holding you back. So think about it. The world's best investors take a very different view, which is why I encourage you to do the same thing. Like us, they concentrate, not diversify, they concentrate on stocks they know will be there when they need them because, again, like us, like we talk about all the time, they play to win. It is a very different proposition than playing not to lose, which is why I encourage you to take a page from their playbook, just like I do. Now, before you blindly rush out to buy NVIDIA at this point, know this. History suggests that there are 10 to 15 NVIDIAs out there right now in various stages of maturity, including one that's 0.3% of NVIDIA's cap. Now, I've suggested that one to the OBA family, and I'm tracking another that's less than 1/10 of the revenue, but I haven't pulled the trigger on it. But I'm looking at it, and I want you to be thinking about the same sorts of things with your own portfolio. If you have it covered, great. If not, you might enjoy one bar ahead, and I'd love to have you on board. Speaking of which, number 5, get on board or get stuck at the gate. We've made no bones about it over the years because we've talked about it frequently. I've done this on national television presentations around the world. Airlines are notoriously poor investments for a variety of reasons. So too are airline makers, generally speaking, including very specifically Boeing right now, given the number of its aircraft has gone down. Now, but stuff that flies, now we're talking, right? U.S. President Donald Trump has just signed 3 executive orders that could turn the U.S. aviation game upside down and unleash an unbelievable amount of profit potential. It's music to my investing ears, frankly. I see 3 terrestrial components. Yes, I'm using that word very deliberately. Terrestrial components. Space is a whole different ballgame, and I've got some ideas there too, but that's a story for another time. 3 terrestrial components. Drones, specifically drones, the beyond visual line of sight operations approved equals massive potential for logistics, heavyweights like FedEx, Amazon, and UPS. And you'll note, not the U.S. Postal Service, because, they're probably not going to do this. They might, but I doubt it. So anyway, I think there's another name that's going to master this faster and more profitably, and it's not a coincidence that the OBA family is already ahead on this count. I also see flying cars, a national eVTOL, E as in electric, vertical takeoff and landing pilot program is going to be officially underway. Now think Joby, Archer Aviation, in a Jetsons-like future. This is going to be the real deal and fascinating. And finally, supersonic flight is back on the radar, pardon the pun. Keep an eye on Boom Supersonic, which is still private, but Raytheon Technologies, RTX, for defense aviation crossover. Too many investors focus on the cool factor, flying cars, drones, supersonic travel, without understanding the real enabler here, though. This is what you want to think about. The real enabler is actually computational horsepower. Coordinating fleets of autonomous aircraft, navigating urban air corridors when everybody else is doing the same thing, and ensuring millisecond safety decisions takes massive real-time data processing and AI-driven systems, not to mention computational power. AI is the secret sauce that will turn futuristic visions like this into profitable realities a lot sooner than most people think. Now, what you want to understand as an investor is that without it, the sky isn't the limit. It's actually a bottleneck. In the way I see it, you can get on board or you can get stuck at the gate. Meanwhile, I'm going to be jonesing for something called a Jetson, and there's a video elsewhere in the written version of this that you should watch, and if not, look it up. It is one of the coolest things going, but we'll see. I don't know if my bride's going to allow me to play with that one. Bottom line today, people have doubts about themselves. That's normal. They have doubts about the markets. That's normal. They have doubts about life. That's also normal. All 3 of these things are normal, which is why I want to encourage you, do not let anybody or anything stop you. Not in life, and certainly not in the markets. You got this. I promise. As always, let's make it a great day. See you tomorrow. Thanks for watching.